Hello everyone. Very good evening to all. Welcome you all in the session of Oliveboard. So those who are watching, please confirm my audibility and visibility. Is everything perfect? Are we good to go? Today we have to start unit 15, that is other non-DCF valuation models. So we have completed, if you remember, we have completed module A, all units of module A. Then we completed module B, and now it's time to complete all the units of module C. So we are on 15th unit of module C, that is other non-DCF valuation models. And moreover, if you have remembered that in unit 14, we have done about the DCF, that is DCF valuation models. Okay, discounting cash flow models. Today, we have to cover non-discounting cash flow valuation models. That if we want to value any kind of business organization, any kind of firm, okay, we have to value that without considering what discounting. That is non-DCF valuation models, non-discounting cash flow valuation models. Without discounting, without considering time value of money. Without considering discounting. Please confirm everything is good. So let's start today's session. Before starting, so yes, this is the selection batch. We have already launched our selection batch, and now the classes are going in a very fluent manner. This is all in one course, and the medium are in both the languages, either English as well as the mixture of Hindi as well as English. So this is the live batch where you are getting what are the benefits you will be provided in this batch. You will be getting 250 plus live classes of all the papers starting from ABM till BRPL classes. Early morning and late evening classes will be there so that you may not have to leave your bank hours. Okay, so non-banking hours will be there. Basic concept clarity. So nowadays the level of question paper are becoming very high. So according to that, we will provide you all the concept, the clarity of each and every concept, the advanced preparation, and weekly live doubt and revision classes. So the revision classes and weekly the live doubt sessions will be there. So where you can ask your queries, where you can clear your all doubts related to the particular unit. And what are the additional benefits you will be getting? That is, no matter it's a live class or it's a recording class, the PDF will be available 24/7. So 250 downloadable study notes, the PDF, all the mock tests we will be providing you of all the subject, unit wise, module wise, 50 plus case study and numerical based tests, and 20 elective paper tests. All these are the benefits that you are getting in this selection batch. So go and grab this offer, enroll now, so to get all these benefits. So let's start today's session, that is the non-discounting cash flow valuation of the company. See, in the previous classes, we have seen that if any owner or if any you can say the business owner wants to value a firm, so they can value a firm in two ways. Either they will follow discounting techniques, that is what? That is discounted cash flow valuation. Discounted cash flow valuation or non-DCF, that is non-discounted cash flow valuation. So these are the two ways, okay, a person can value the firm. If any of the firm, like these are the two person, this person wants to purchase the business organization of this person B. Now, how to value the firm, whether they will follow the discounting or non-discounting techniques. The valuation methods are broadly divided into two groups, discounting and DCF, non-DCF methods. In this unit, we will learn the valuation models which uses non-discounting cash flow valuation methods for valuation. And what are the models? The relative valuation, equity valuation, multiples model, enterprise value multiples model, book value approach model, and stock and debt approach model. So we have to cover all these models in this particular unit. We will cover in today's session, we will cover one, two, three, because it is not possible to cover all the models in half an hour. So we will be going relative equity valuation and enterprise value multiples model. Now, what is relative valuation model? Relative valuation model is what, suppose you are the person, you want to purchase this business organization. Now, this business organization is ABC Limited. But the problem is that you are unable to find the accurate valuation of this firm. So what you will do in this case, you will find all those business who are working in the same manner as this particular business ABC Limited is working. So you will find what the relative business of ABC Limited and what the valuation of that business is. Let's take an example, the PQR Limited. Okay, this PQR Limited, this business is entirely the same business of ABC Limited. Its assets, its working model, the business scenario, okay, the scenario analysis, everything is same. The ways, methods, tool, everything, both the business are same. Now, we know the value of this business is 50 crore. So, what you will do, you will also take this business in that value, that is 50 crore. The business owner is selling you this business at 80 crore. Now you are saying no, your business and this business is entirely same. Okay, all the assets are same, all the trading are also done in the same manner. Then why I will be paying you 80 crore instead of 80 crore? I have being claimed this business worth rupees 50 crore, so I'll be also paying you the 50 crore because your business and the PQR business both are same in every manner. So if this business organization, if this company is costing rupees 50 crore, now I will be giving more than 50 crore. So this is what the relative valuation model, where you will value the firm on the basis of the relative approach, on the basis of the similarity approach of another business. This model values a business or asset by comparing it to a similar business. Now, this business is being compared to this business, and the whatever the value of this business is, this person will going to pay the same value to this business. So the comparison method we have to use over here to find the actual value of the company that are already publicly traded. The basic idea is that companies operating in the same industrial sector should have similar valuation multiples. So definitely this business or this business, they both have the similar valuation multiples. Either you can say the price to earning, price to sale, price to book value. So everything, the multiples will be same. Now, for example, when selling agricultural land, you could use the price of a comparable property, estimate the value of your own. For example, let's take an example. You have 15 acres of land. Okay. This person is having 15 acres of land. Now, if another person comes and another person says that I want to buy, okay, 5 acres of your land. Now, tell me the value, at which value you will going to sell me. This person is unaware of the value of the land. Now what this person will do, this person will go and compare in the market that right now what is the price of the 1 acre of land. Let's take an example, 1 acre of land is costing rupees 5 lakh rupees. So similarly, this is having what, let's take an example, 10 acre of land. Okay, now 10 acre of land. Okay, so if this 1 acre of land is costing 5 lakh, so 10 acre of land will cost rupees. To make it more easy, I have taken 10, that is 50 lakh rupees. Means 10 acres of land will cost 50 lakh. So according to the value of this 1 acre of land, you are analyzing your 10 acres of land at 50 lakh rupees. So this is what, this is a relative valuation approach that does not follow the discounting technique. Now now read this example, it will be more clear to you. For instance, when selling agricultural land, you could use the price of a what comparable property to estimate what to estimate the value of your own land. For example, if a 2-acre plot recently sold for rupees 10 lakh, for example, if 2 acre was sold for rupees 10 lakh, it means 1 acre is how much? 1 acre is 5 lakh rupees. Now, you would value your 5-acre plot at 25. Now, what is the value of 5 acre? 5 into 5, that comes 25. So, with the help of this value, you have found your value of your land. So, this is what? This is relative valuation model. We call it comparison model also. I hope this particular model is clear to you all, the relative valuation model. Any doubt to anyone? Very important. Module C is very important. And all the units are very important in this module C. So we have done what? We have done the first model, that is relative valuation model. Now, next is equity valuation multiples model. So here we are using the multiples of different elements. Equity valuation multiples model. Now, figuring out the valuation multiples for other comparable companies. Now, if there are many different companies, okay, the comparable companies means those companies from which we are comparing our own company. That is the comparable company. So calculation of the valuation multiples for each of the similar companies by using what? Different financial characteristics, values of company being compared. No. So here we have taken two comparable companies, company A and company B. And with its multiples, we are finding the valuation of the company. So how to find the valuation of the company? With the help of comparison, the comparable companies method. So sales of two companies are given, company A and company B. Sales are given how much? 6,000 and 9,000. Now, EBITDA means what? Earning before interest and tax. That is 1,000, and company B is what? 2,000. Book value of assets, both the companies are given 4,000, 6,000. Enterprise value, that is EV, it is 3,000 and 4,500. Now, valuation multiple models for company, what it says that we have to find the multiples of different companies, and accordingly that we have to find the value of the company. Now, how to find the value of company with the enterprise value model? So this is what enterprise value multiples model. So now we are covering third one, enterprise value multiples model. See how to find enterprise value of company A upon EBITDA. EBITDA is how much? 1,000. Enterprise value is how much? 3,000. Now 3,000 divided by 1,000. 3,000 divided by 1,000 is how much? 3. Correct, correct. Now enterprise value upon book value. Enterprise value is how much of company A in book value of assets, that is 4,000. Okay. Now 3,000 divided by how much? 4,000. How much you will be getting? Calculate and tell me the value. Come on, calculate and tell me the value. 0.75. Now enterprise value is how much? Again 3,000 upon sales is how much? 6,000. So company A is 0.5. Similarly, in company B, EV upon EBITDA. EV is how much of company B? That is 4,500 upon EBITDA is 2,000. So if you will calculate, you will be getting your answer 2.25. Again, 4500 Upon how much? 6,000. This will be the answer. Upon sales is how much? 9,000. 0.5 will be the answer of company B. Now the last step is what? How to find the average of both of the companies. So simply what we do that, okay, we don't add, we have to find the average. That means we have to sum up and divide it by both of the companies. So if you will do 3 plus 2.25 divided by 2, you will be getting this answer. If you will do 0.75 plus 0.75 divided by 2, you will be getting this answer. 0.5 plus 0.5 divided by 2, you will be getting what? 0.5 as the answer. Am I clear? So this is what? This is the enterprise value. How to find the value of the enterprise with the help of comparable approach, the valuation multiples of the different companies. So here two companies are given. Might be in the exam they will ask of only one company. Here two companies are given just to give you the average. That is why. Done. Here everybody. Okay. Now, so here is one more, that is enterprise value multiples model. Just what we did over here. Valuation multiples model. See, enterprise value multiples model is a method of valuation that focus what? On total value of all the business. So here also we have taken total value, the profit, the book value of all the assets, all the sales, the total value of all the companies minus the cash, because they will not going to take your own cash. Na? The cash, the liquid money is your only. So now if to value any kind of business or firm, so cash is not taken in that case. The cash or cash equivalent. So it includes what? All the equity, all the liabilities, okay, all the debt, all the loans, everything, the entire capital structure. So capital structure is what? Basically the composition of the business. The composition of business, that is equity plus debt. So with the help of enterprise value multiples model, what happens? It will give the broader view of all the company. Broader means the holistic view of a company's valuation. So enterprise value, it represents total value of businesses. It includes debt minus cash and cash equivalent. So equity plus debt minus cash. That is what? The enterprise value. Okay. But if you will see the enterprise value is already given to you 3,000. Suppose enterprise value, if they give that equity plus debt minus cash, now equity is 2,000 plus 2,000 minus 1,000. So 3,000 will be the what? Enterprise value. In this example, the enterprise value was already calculated and was given to you. But how to calculate enterprise value? The equity plus debt minus cash and cash equivalent of the company's balance sheet. Am I clear with this? Tell me. Okay. Now, now equity valuation model is what? It also includes the multiples valuation model, that is PE multiple. PE what? Price earnings multiple. PB price book value multiple. PE stands for price sales multiple. Relative PE ratio is what? The comparison, which just what we have done. Comparison. And relative PE is current PE ratio firm upon current PE ratio market. The firm upon market. So what? This is the equity valuation models. See, what, let me tell you one thing. So basically what happens, okay, the price to earning ratio is what? See, what is price to earning ratio? It basically tells the ratio of share price of stock to its EPS. And what is EPS? I have already told you that is earning per share. Means what is the value of how much you will going to earn from a single share, that is earning per share. Done. Market market price per share. So PE ratio, the formula is what? PE ratio formula is market price per share upon earnings per share. This is the formula of PE ratio. Now, price to book ratio. So it basically helps you to evaluate the valuation of company stock. Okay. Also, this ratio compares a company's market price to its what book value. So we can say, we can write the formula as market price per share book upon value per share. The current market price of a single share of a company stock, the net asset value of the company per share. That is value per share. And how to find book value per share? That is book value per share, total assets minus total liabilities. This is book value per share. Now, price to sales, again, it includes what? The market price per share upon revenue per share. Done. So this is what? This is all the multiples valuation model. And enterprise valuation model we have done. We have done equity valuation multiples model. So this is what? This is equity valuation multiple models. This was enterprise value multiple models, relative valuation model. So we have completed today three valuation models. Book value approach model, I have given you the formula. Okay, and stock and debt approach, this we have already done in discounting, if you remember. Discounted cash flow there. So I hope you have understood. If you have any doubt, you can ask all your doubts in the comment section box. I'm waiting for 1 minute or else we will end this session. Well, let's meet tomorrow sharply at 8:30 p.m. for ABFM and 9 p.m. for ABM. Okay, so these are the two timings where I take daily classes on the YouTube channel. So thank you all for watching the session. I hope you like the session, and if you like the session, if you feel that session was interesting, okay, you have understood any concept, then kindly like the video and share it with others as well. So we'll meet you tomorrow at the same time. Till then, take care everyone. Goodbye. Keep studying. Keep watching.